The price of oil continues to swing amid the volatility surrounding the Strait of Hormuz. My next guest says from an investment perspective, many may be getting it wrong by treating the U.S.-Iran conflict as a temporary disruption. He says a deeper structural shift is beginning to emerge across the commodity space. Andriy Yastreb is Vice President and Director, Multi-Asset Strategies at TD Asset Management, and he joins me here. It is lovely to see you.
Good to see you, too.
I think it started off maybe as a temporary disruption, but, it's like, how does one define temporary? I mean, if it lasts over a certain amount of time, it becomes a bit more permanent. Why do you think investors are underestimating the risk right now?
So I have a chart here which shows the relative performance of energy sector in the United States versus S&P. And if you look at the chart, the interesting part about it is that it peaked in late March.
Yep.
So since late March, even though we have the crisis and oil disruption is growing, energy has been underperforming relative to the broader market. And when you think about the reasons why, I think part of it is that we do have peace progress on and off over a period of time, but the ceasefire largely holds. And it looks like market decided that if this continues, if status quo continues here, we probably get into a recessionary environment, and most likely decision makers decide to avoid that. So market seems to have decided that most likely outcome is that there is a peace deal and this is not going to be a big problem. I think the other part of this rationale, if somebody told me, or a lot of my peers a year ago, that Strait of Hormuz will be closed for over 2 months and oil will be at 100, would be surprised, because this is the crisis that people talk about for decades, and everybody assumed that it will be at potentially new highs, all-time highs, right? And we're still pretty far from that. And I think the other part of rationale for that is that we've prepared for this crisis for decades, right? There's a lot of oil in storage in SPRs, and a lot of those buffers are being used to protect us in the short term. If you think about the magnitude of disruption so far, we lost maybe 600, 700 million barrels of production. Well, the global above ground inventories and SPR inventories are about 8 billion barrels. So far we used maybe less than 10% of global storage, but we're losing more than 10% of production, and the market doesn't seem to be focusing on that.
Interesting. So all the buffers, rationalization, people are expecting all that, and maybe expecting a bit too much. You brought a chart here that shows us oil tankers and how the closure of the Strait of Hormuz have affected. Just tell me what we're looking at here and why this is notable.
So this is a map that shows known locations of very large crude carriers. So those are the biggest tankers. Each tanker can carry about 2 million barrels at a time. And if you look at it, it's an interesting pattern. There's 2 major routes. One is from the Middle East going to Asia, and the other one around Africa going to Asia as well. And obviously, with the disruption in Strait of Hormuz, we don't see as many tankers as normal coming from the Persian Gulf. But the point here is that the market has adjusted temporarily to the disruption. Obviously, that's putting a strain on the tanker market, and adjusting back will take time. But the question in my mind is what happens when Hormuz reopens, right? Because in the moment, we have a shortage of oil in parts of Asia and potential parts of Africa. They're feeling some pain. But at the same time, there's a lot of oil that is stuck in the Middle East and cannot get out. Some of it is on tankers and will get out as quickly as Hormuz reopens, depending on the situation. Some of it is on land tanks. And those need to be emptied so that new production can flow into them, right? So the question is, how quickly can we start clearing that glut of oil in the Middle East? And I think if you look at that map carefully, there's a lot of tankers that are going back and forth in the Indian Ocean. I think when Hormuz reopens, we'll see a lot of tankers coming in. And there's also a lot of tankers that are sitting outside of existing terminals in Red Sea and in the Arabian Gulf. So my point here is that full normalization, getting back to normal, whatever that will look like, it will take months, maybe 3 to 6 months. But getting tankers in to clear the glut, we probably will see that within a week or 2.
Interesting. So it's funny, though, because even if it gets resolved today, you're still looking at 3 to 6 months of disruption when it actually happens. We've got some other charts here I want to get to as well, too. You show one here that shows oil consumption globally. And I wanted to highlight this and kind of combine this with another thought that I have, too, about the world isn't as dependent maybe on oil as it once was. But maybe, and also when you think about the 70s, the last time we had a big crisis, we've got also, because we're not as dependent on oil, we have other alternatives, like there's solar, there's other nuclear, there's other places as well too.
Absolutely. So if you look at the chart, what it tells us, last time we had a disruption wasn't that long ago. It was back in 2020 to 2021 because of COVID. And the interesting part there is that we had a sharp reduction in oil consumption, then we rebounded, but we never came back to the same trend line as before.
That's fascinating, just in that one time.
Exactly. So it's interesting that we came back, but not to the same level or same trend line, which tells you that either the economy became a lot more efficient and we're not using as much oil per unit of GDP as we used to, or we're getting more advanced in using alternative technologies like EVs and solar panels and energy storage. So that's one part of that. And then you're correct to point about the 1970s. That's the last time we had similar degree of disruption in oil market. And if you step back and look at this from 30,000 feet, there are two things that happened after 1970s. One was that everybody who could started looking for oil elsewhere outside of Middle East to diversify away. And that's when people started to drill a lot more and produce more in North Sea, also in northern slope of Alaska, in places that before that either were not attractive or didn't make sense, right, or had other issues. And the second part was that consumption has changed as well after that. We had smaller cars in 80s than in 70s, and changes in requirements in technology. Yeah. We also had nuclear in countries like France and Japan. They made a hard shift towards nuclear and built dozens of reactors partly as a response to that crisis. And so we had the technological response as well on consumption. I think your point is interesting that if you look now, we don't just have nuclear, which is also going through renaissance. We also have EVs, and we have solar and wind, which now is a lot more common, makes a lot more sense in these prices, a lot more competitive, and can be deployed at scale.
You outlined all the kind of what you're looking at in terms of scenarios of going forward. Let's bring it back down to the bottom line here. When you think about investment implications, short term and long term, let's start with the short term. How do you see it?
Well, in the short term, we're in the middle of the oil crisis that we feared for decades, right? This is probably the worst scenario for oil supply that could happen. And as we've seen in this environment since end of February, when this crisis intensifies, oil is the best hedge, right? Because if this scenario continues and we don't have a resolution within weeks, maybe a few months, we probably start talking about recession, because that's how big the disruption is. In that scenario, obviously, a lot of other asset classes and a lot of other assets will be coming down. So in the short term, while this continues, oil is the best hedge against that scenario. From kind of historical perspective, if you take oil price over history and adjust it for inflation, that peak that we had in 2008 was, if you adjust it for inflation, in today's dollars, it's over $200. It's somewhere between $200 to $120, depending on inflation numbers you use. And the scale of this disruption could bring us there if this is not resolved at some point.
Long term, then? I mean, you just talked about the scale where we could go, but what do you see in the much longer term from what really diverts, let's say, money flows?
So this is very interesting, right? Because if we don't have disruption that lingers, if we have a resolution that provides some kind of equilibrium in the Middle East, then we have the crisis now. We already have elevated oil price. Probably oil needs to come down. But then the interesting part will be the response from consumers, response from policymakers. And again, we need to go back to 1970s example, because after that, policymakers wanted to diversify away from oil and also diversify away from Middle East with production elsewhere.
Yeah, they want sovereign control.
Exactly.
Right?
And we're probably going to see more of that over time. And now we have more tools in our toolbox. And we don't just have nuclear, we have EVs, we have solar, we have energy storage. And I think a lot of that will benefit the whole basket of renewables or alternative fuels, from nuclear to lithium and energy storage to others.
I was going to say, and an overlay of like a surge in power demand with things like AI and data centers.
Absolutely. So long term, I think on top of data centers, we'll have this policy response. And in the short term, even now, we're seeing already response from consumers, where in a lot of countries, if you look at the data of EV sales year to date, in a lot of emerging markets, EVs are growing 60, 70% year on year. And it's not driven by subsidies or policies in those markets. It's driven by the fact that there are cheap EVs available, and they're already competitive with gasoline cars.
They're cheap in some places, not in all places yet.
No, not yet.
That's a Canadian conversation. I have only got about a minute left. I wanted to talk to you a bit about gold. And I understand you brought us a chart here. So I'm asking you about gold, and you brought me a chart about U.S. debt levels. So tell me why we're talking about this.
In the long term, the biggest driver for gold will be what will happen to fiat currencies and how the value of those currencies will change over time. And what this chart shows, it uses data from Congressional Budget Office in the United States. And I'm taking the data from the same source, both historical and projection, and just dividing the U.S. federal government debt per each employed person in the United States, 16 years and older, by the way. So that's an interesting tidbit there. And if you look at the data, back in 2017, the debt per person was $95,000. Now it's almost $100,000 more, so we're increasing debt per person by $10,000 a year. And by 2035, it's projected to be $300,000 per each employed person.
I'm wondering, are the employed persons going up too? Like I was going to say.
Not really.
No?
If you look at demographics, it's flatlining, right?
Okay.
Because population is getting older and labor force is slowing down, right?
Yeah.
So debt is growing, number of employees is not increasing. So hopefully we get help from AI and robots at some point. But if you look at this data just per person, that 300,000 per each employed person, it's quite scary because it doesn't look sustainable. To put it in perspective, average mortgage in the United States is about 385,000 per household, not per each employed person. And
so then then briefly, then the value proposition for gold continues then, I assume.
Exactly, because that problem is just snowballing. There's no solution from politicians that is being proposed or on the radar. And eventually that might raise more and more questions about the value of US dollar long term. And that should benefit alternative assets, and gold is probably one of the top ones.